Hi, and welcome to this morning's early global view. It is currently 6:30 a.m. U.S. Central Time on Monday, June 27th, 2016. And needless to say, it's been a very tumultuous couple of days. We're going to skip the rest of the discussion of any fundamentals because the overriding fundamental is the success of the Leave campaign in the UK referendum on EU membership. So it's triggered the Brexit, the British exit from the EU. And yet, rather than being clear-cut, the Remain campaign knew they were for the current structures with some further evolution, whereas the Leave campaign, nobody's quite sure what that means, as internal politics in the UK have become very muddled, with David Cameron, the Prime Minister, resigning, which you all knew, and yet also, while we're waiting for a new leader of the Tories, the Labour Party as a leadership challenge to Jeremy Corbyn. And also within Europe, there's a certain amount of opposing opinion. There are some in the core EU6, the original founders of the European Union, who are in a hurry to see the negotiations with the UK proceed on their terms of exit from the EU, yet others are saying, well, we don't have to be in a hurry, and we certainly don't have to be acrimonious about it. And that includes none less than the big dog, Angela Merkel, German Chancellor, who has said there's no need for any rush. And in fact, moving over to the intermediate term view, this is really where we get to take a look at the quick take, because we're back into such critical major levels, which is 2020 to 2010. We put this $5 either side of the 2015 down break from the Chinese currency displacement, the lead up to it, going into Monday, August 24th. So that was a big down break, and it's been the major over-under. And when it's below it, the market, historically, we had said, tended to swing down to 1900, and yet on recent form, it's broken down into the mid to low 1800s. In other words, very near the Ebola scare sell-off low from back in October of 2014. And so we have to keep a close eye on the 2000 area, as we said previous, as the tolerance on 2020 to 15. And in fact, you can see how minor slippage late last year didn't amount to much below there, because it gapped back up and was right back above it the next week. But starting out this week, near that area leaves it that much more critical. We also have the 41-week average, our proxy for the 200-day, right here about 2015, which means much below 2000, be violating that once again. And we also have to allow there's some interim congestion right around the 1950 area, give or take a few dollars. And that's not only the quick take, but that really is the summary for the intermediate term, except to note that, once again, none of these situations on the fundamental side are due to clarify soon. So with UK politics in a bit of disarray, the only thing we would have to say that is a mitigating factor is that it's up to the United Kingdom to trigger Article 50 of the European Union Treaty, and that is their official notification that they are requesting to leave. And while there's some in the Eurozone who would want to have a very speedy process, the fact is that is elective on the part of the UK. David Cameron has said it should probably wait for his successor, and there's very good likelihood you won't have a new Prime Minister from the Tory party until the October party convention. So this is going to be a distended process with a lot of uncertainty along the way. And that pretty much does it for the S&P 500.